This year, investors have faced a recession, stubbornly high inflation, high interest rates, and bear markets for both bonds and equities, but alternatives have just continued to gain steam. With that said, the only constant in the alt industry seems to be change, and that's why I'm excited to introduce Kevin Gannon, Chairman and CEO of Robert A. Stanger and Company, as our keynote speaker for today's event. Mr. Gannon joined Stanger in 1983, and he's a frequent speaker at industry events produced by IPA and ADISA, among others. And he's also frequently quoted in the Wall Street Journal and by other major financial media. Kevin, I see you here now. It's great to have you join us on Alts Expo today. How are you doing?
Doing great. Okay, a little background on us. We're an investment banking firm. We've done about $100 billion worth of M&A transactions. We do a lot of real estate appraisal work. So we're very active in value in real estate. We collect data on 25,000 untraded securities out there. So we're knowledgeable about everything going on out there. And we do some litigation support work. This is not an advertisement. I'm just trying to put some context as to who you're talking to. Next slide, please. We have a bunch of publications that are pretty well known. The Stanger Report, the Stanger Interval Fund Report, the Stanger Digest, all tracking non-traded REITs, BDCs, and interval funds. The IPA Stanger Monitor tracks the performance of all non-traded REITs and BDCs. The Chairman's Report is tracking non-traded REITs and BDCs fundraising, redemption activity, which we'll talk a lot about today. And the Market Pulse tracks fundraising activity. So those are all things you can look at and form the nucleus of our information here. Next slide, please. We also write equity analyst research reports on the major non-traded NAV REITs. So you can see a list there of all those that we cover, and they're pretty in-depth reports. So again, if you want to get up to speed on what's going on in a given deal, you can get those research reports, and they'll be pretty helpful for you. Next slide, please. That's just our transaction history activity. Next slide. We don't have to go over that. Extraordinary evolution of events. We think there's been an extraordinary evolution in this space the last 5 years. There's been extraordinary fundraising, extraordinary volume of capital markets transactions, extraordinary number of new major players entering the space. There's been extraordinary performance, and now most recently, there's been some extraordinary redemptions. So redemptions are something we're going to talk a bit about, and what the significance of that is. It's all very positive in our view. We think the features of this program, having a 5% a quarter, 20% per annum redemption feature, is hugely different than anything we've ever seen before. And the fact that the sponsors are meeting it and continue to meet it, we think that's a great feature to these programs. Next slide, please. This is in terms of evolution. I did some evolutionary research earlier this year. I went down to the Galapagos Islands with my wife. And we saw a lot of evolution down there, or things that evidence evolution. People often ask me that rightmost picture. They said, Kev, how do you get that? How'd you get that seal to stand up and put a hat on? That big fat seal. That's me, actually. So at the end of the day, evolution is all part of our theme here. So keep going. Let's next slide. Next slide. Okay, fundraising in our space the last couple of years: 28 billion in 19, 29 billion in 20, 84 billion dollars last year, 2021. We think this year we're already at 92 billion. It's going to be probably close to 110 billion all in. Non-traded REITs, BDCs, preferred stocks, non-listed preferreds, interval funds that we track, Delaware statutory trusts, OZ deals, and other private placements. So the activity's been fairly substantial. Again, we think $110 billion across all these different categories this year. Next slide. These are the players in this space last year across the top. And what you see is the players are in multiple silos. They have non-listed REITs, BDCs, interval funds, OZ deals, DSTs. So multiple players offer multiple products. Big players: Blackstone, Starwood, Cliffwater, Silver Bay, Ares, PIMCO, Blue Owl, Blue Rock, Griffin, Inland, and make up the top 10. Next slide, please. This is, again, more players in the space that make up the $84 billion from 2021. Next slide. This is 2022 year to date. Again, Blackstone at the top with $30 billion. Blue Owl after them. Cliffwater, Starwood, Apollo, Blue Rock, HPS, Ares, PIMCO, and Nuveen round out the top 10. Next slide, please. Again, more of the top 40 making up the $92 billion of money raised year to date. Next. Capital market sponsor activity. There's been a number of transactions done in 2021 in the life cycle REITs and other products. Guys are looking for the exit, right? Ultimately, they merge together and they think about a listing. They think about going full cycle in some way. We had $45 billion of transactions in 2021, which was pretty staggering. A staggering amount of AUM combining in to prepare for the next phase, which is usually a listing of some sort. Next slide. In 2022, we've had $52 billion of transactions. And again, all these things moving towards creating a liquidity event. We think that's great. That was fundamentally all the old life cycle REITs and BDCs that were looking for an exit of some sort. And again, many of them have either achieved it or have them pending. Again, in this cycle, we didn't stick our head in the sand. We look for the exit. And that's, I think, a very important distinction that happened with these life cycle REITs. It was just a great outcome. And they went full cycle. They created that big liquidity event. All well done. Next slide. We've had some sponsor transaction activity. Apollo acquired Griffin, Ares acquired Black Creek, Brookfield acquired Oak Tree, Colliers took out Versus, and Greystone bought a big interest in Pasco. We think all those reflect to us sponsorship upgrades. We've seen some big sponsorship upgrades in our space, and that's a big theme of what's been going on here the last couple of years. Next slide, please. We have other newcomers entering the space, quite a staggering number of sponsors entering the space. Angelo Gordon, Apollo, Ares, Bain, BlackRock, Brookfield, Conversus, Stepstone, Fidelity, Greystone, Pasco, HPS, Invesco, JP Morgan, KKR, Oak Hill, PGIM, and I'll tell you, there's at least a dozen more that I know of coming this way. So all big sponsors, big upgrade. We're not dealing with a bootstrapper sponsor who's just trying to make himself credible. We're dealing with guys that have large institutional presence. So we think it's just phenomenal. And again, there's a whole bunch more coming down the pike. Next slide, please. Non-listed REITs, kind of summarize them. They've raised about $34 billion last year, over $30 billion this year. New players, Invesco, KKR, Brookfield, Apollo, JP Morgan, and PGIM. I mean, those are staggering names going through the space, and new guys contemplating coming in. Next slide. This has been a capital raise. We were tracking it as it went through COVID and kind of what happened, and it peaked out, 20 or so months after COVID started, and now we're at about $1.4 billion run rate, so it's come down quite a bit, but still, fairly substantial fundraising. Next slide. We think last several years, going back to 2011, we're $8 billion. Its previous peak was $19.6 billion in 2013. 2005, the 15 thing with FINRA that kind of caused this space to contract a little bit, and as well as the ARC noise that causes space to contract. And we're past that now. We did $36 billion last year in non-traded REITs, and this year $31.5 billion. And pretty staggering numbers. Next slide. The big players on the NAV REITs: Blackstone, Starwood, Ares, FS Hines, JLL, Nuveen, KKR, Ares, and Brookfield round out the top 10. But you can see a list, 20 plus players. We think this space is going to grow substantially. There's going to be a lot more players in it, bringing product and bringing opportunities to the table in a broad set of products. Next slide. This is kind of an interesting table. There's been a lot of noise about redemptions. This table shows for the non-traded REIT space the last 12 months, so $40 billion in the trailing 12-month period. The last couple of months, we look more like $1.3 billion. We don't have full numbers for November and December yet, but assuming they're about where we were in October, that's kind of what we're looking at for this quarter. In terms of drip activity, we think the drip's about $500 million per quarter, and the redemption activity, which has kicked up a bit, is going to look more like maybe almost 100% of fundraising and maybe 4+% of NAV, right? So that's what's going on. And that Blackstone and Starwood had hit the 5% cap. This space, as you know, was designed with a liquidity feature that said we'll give you 2% a month, 5% a quarter generally, which is staggering. Those are gigantic numbers, 20% a year, unprecedented for this type of illiquid product. And not only are these guys meeting those redemptions as they come in up to that cap, but they have a long runway, a really long runway for the ability to meet it because they maintain liquidity sleeves. And people redeem for all kinds of reasons, right? They got to change the circumstance. They think opportunities are better elsewhere. They don't like the opportunity perhaps that they're in. So there's all kinds of reasons. Now they can move out into another product. We think it's a great feature. We think that we should cue the chariots for the guys who are meeting these redemptions like that at those kind of levels. We think that's extraordinary. We think it's going to be it's a healthy thing to be able to do. Let people get out of an investment and move on to something else, and diversify their exposure to real estate. We think it's all good, and it's going to be a very positive thing long term as we're dealing with some redemptions that have queued up so far this quarter. Not everybody gets out when the redemptions are bigger than 5% a quarter, but they'll roll over hopefully into the next quarter and then get redeemed over the next couple of months. We think that's fine and appropriate and expected. There's nothing unexpected that's going on here. Next slide, please. This is BREIT showing BREIT kind of how they performed. Again, their redemptions were probably greater than their fundraising at this point, and we're going to be going to hit that 5% cap. That's what will happen this quarter. So their NAV has stayed pretty constant, actually gone up this year. So we'll see how that all plays out. Will their NAV continue to hold at a pretty solid level? They're a good company. They seem to be doing all the right things, investing in the right asset classes, a lot of multifamily and industrial. So that's really been a big part of their whole story. Next slide, please. Starwood, same thing. They're going to probably hit their 5% cap this quarter. So we think that is, again, they're meeting it. They have plenty of liquidity. They're ready for it. There's no surprises here. So it's going to be good. Investors are going to be able to make those decisions and hit the exit button if they want to hit it and stay with it. And we'll see what happens with the NAVs. The NAVs, we're watching them very carefully. They've moved up. They've gotten in November, they took it down a little bit. We'll see what happens month to month over the next couple of months. Next slide. Real estate allocations. What our space, the NAV REIT space, fundamentally has done so well because of residential and industrial exposure. That's where the money is really focused, and those asset classes have hit it out of the park. We met with John Gray back in 2017 and said, what are you going to do to run these things? This industry had always grown up on office and net lease. He says, I'm doing the opposite of that. I'm doing residential and industrial. Great call. Everybody followed suit, and they hit it out of the park the last 5 years. Next slide, please. This is how they're constructed. You can see BREIT, SREIT, Ares Industrial REIT, and JLL. The other ones will be on the next slide. But you see their exposure is fundamentally heavily concentrated residential and logistics. Their leverage is in the 50s. Generally speaking, AI REIT, Ares is lower, as is JLL. But they're constructed well. They're not over leveraged. They're nicely constructed. They got good asset class exposure. We like what they did. They really did a stellar job constructing a portfolio for the investors. And look, they got $140 billion of assets and $70 billion of equity in just BREIT alone. So we think that this is a real tribute to the space and a tribute to investors out there trying to get exposure to some really good talent in terms of accumulating portfolios. Next slide, please. You see the same thing for Hines, the other Ares REIT, Nuveen, which is CG, Crest is KKR, and BF is Brookfield. Again, they're all similarly constructed in terms of exposure to different asset classes. Leverage levels vary from 30 to 60%. Again, no big outlier that you say, oh my God, that's way too leveraged. So we like how they look. Next slide, please. They're constructed fundamentally with a base management fee of 125 basis points on equity and an incentive fee that's 12.5% of total return, subordinated to a 5 with 100% catch up inside the 5. That's fundamentally how they're done. JLL is done a little differently. They have a 10% incentive over a 7 and no catch up. So that's a little different. Next slide, please. The folks at Hines and Ares and KREST all have similar type structures. KKR does not get an incentive on appreciation of the real estate. They only get an incentive on performance of the operating income. So they get a preference that way. The folks at Nuveen don't get any kind of incentive. So that's a bit of a different. They don't collect an incentive. Returns have been strong. And we think they're poised to deliver good, solid returns. It's going to be hard to replicate the last couple of years just because the returns have been so staggering. Go back one slide, please. You see B-REIT and S-REIT and AI REIT and even JLL have had close to double-digit returns last year and the last couple of years. So they've been pretty staggering, something to be pretty excited about. Next slide, please. Keep going. Performance. Next slide. The performance of this is the really the most staggering slide in the whole deck, and that is we've had performance that's outperformed the traded REIT environment. Non-traded REITs as a group have outperformed traded REITs over the last couple of years. A 71% total return versus returns that are in the 15 to 20% range. So they've really done well. The traded REIT market trades sometimes at a premium, sometimes at a discount to NAV, and those features really kind of distort the returns that can be achieved in the public markets. The non-traded REITs generally rely on NAV and underwrite NAV and do a good job doing that. And at the end of the day, have produced some very solid returns over the last 5 years, well in excess of the traded REIT world. Next slide. This is how various have performed. So you see the 1 year, the 3 year, the 5 year returns have been fairly staggering for this space. Again, because of the concentrations in non-traded REIT, in multifamily and industrial. Next slide. Clarion and KKR, they're structured as tender offer funds, so they're a little bit different, but again, produced some whopping returns the last couple of years. Next slide, please. Life cycle REITs, that's the earlier generation. They've had some pretty good performance the last couple of years, pretty staggering overall returns. Again, some multifamily exposure as well as self-storage exposure has really contributed to a lot of that. Next slide, please. BDCs. BDCs, we've seen Blackstone come with BCRED, Blue Owl, Apollo, HPS, BlackRock, and then Ares, and a few others are currently in the pre-effective pipeline, raising some pretty good money. Next slide. You see the fundraising here this year. Looks like this year about 22 billion year to date, cumulatively about $56 billion from these products. And we're seeing the new sponsors, they're juiced up, the yields are higher. They got the financing is a lot of variable rate debt, variable rate financing that they use in these investments. And they've kicked it up. I think I saw BCRED just kicked up to 10.2% as their current yield. So all of them are moving directionally in that way. So it's going to be a good year, we think, for BDCs. Next slide, please. BDC fundraising, there's been some redemption activity that you'll see 2.4% in the last quarter. So we'll see how that all plays out. Fundraising's off a little bit from earlier in the year. It had been about $3 billion in January and February, and now it's more like $1.2 billion, $1.1 billion. Again, we had a surge in the first half of the year, and as rates rose, things leveled off a little bit. So, but again, we're very optimistic about the fundraising potential for these BDCs. We think that yield coupon is going to be a huge attraction going forward. Next slide, please. Performance of BDCs is catching up. It's getting better. It's dragging a lot of legacy performance with it as we look at an index. But it's all very promising. We think it's going to be, we're going to see things that look like high single digit, double digit types of returns going forward on the BDC world. Next slide, please. There's some of the players in the space, how they've done 1 year, 3 year, 5 year, and since inception. And we're starting to see that kick up. The dividend yields, as I mentioned earlier, BCRED moved up to 10.2, and others have also moved up. So we're going to see that kind of push things up a little bit and help the fundraising for this category of investment. Next slide. Current offerings out there, again, Apollo, BCred, HPS, Oaktree, Alrock, 2 Alrock deals. You see 7 to 10% coupons on those deals. So again, very attractive. We expect to see a lot of fundraising here. Next slide. Interval funds. The interval funds, how we're doing timing-wise. We're a little out of time here. The interval funds raised a lot of money in 21, $18 billion, netted $15 billion net of redemption. Next slide, please. This year to date, $21 billion in gross, $16 billion in net. Next slide, please. Inception to date, $74 billion that we track on 80 deals, $53 billion of net fundraising in this space. A lot of redemption activity occurs because of liquid nature of the interval funds. Next slide. This is a list of all those players out there: Cliffwater, Silver Bay, Blue Rock, Apollo, PIMCO, Scion, Variant, Carlisle, Pioneer, and Rise are the top 10. So again, $64 billion from 17 to now. Next slide, please. You see they invest in equities, debt, and real estate. So that's fundamentally what you see in the interval funds. Next slide. And returns for as of 9/30 for the various categories. Again, all of this we expect to be improving this coming year. Some corrections in the past year, and we expect it to get cranked up here in the next in 2023. Next slide. We'll skip that. Next slide. Private placements, a lot of private placement activity. We track about $16 billion year to date. DSTs, QOZ deals, and other Reg D products. Blue Owl, Inland, Ares, Capital Square, Exchange Right, Cantor Fitzgerald, Barings, Next Point, Greenbacker, and Pasco are the big players. So we'll see a lot more of this. There's a lot of stuff going on in the private placement world. Next slide, please. Non-listed preferreds, let's skip over that for now. Private equity funds, a lot of stuff going on, and PE funds coming into our space. Conversus, Stepstone, Blackstone, BlackRock, Ares, and a couple other deals, another Conversus, Stepstone, and a Constitution Capital deal. So people are looking for that additional exposure. Next slide. Okay, this is the most important slide in the deck, and I'll end it with this slide. My family throws a big St. Patrick's Day party, and everybody on this call is invited to it. And it's held in Boonton, New Jersey, my hometown. And we had the first open bar last year in 56 years. We cooked up 337 pounds of corned beef and a couple 100 pounds of potatoes and cabbage. We bring in pipe bands and Irish step dancers, and it's a good time too. Somewhere between 300 and 400 people typically show up at these things, and it's a lot of fun. It doesn't cost you anything. We do it in honor of all first responders. My family is a bunch of cops and firemen, so we do it for them. So if you can get yourself to Boonton on the March 11th of this year, look for the Boonton Sokol Hall. We found out we're going to actually have it there. They sold it to a mosque, and so we were worried they were going to kick the Irish Catholics out, but they didn't. They're going to let us hold a party there. So we look forward to seeing you. Try to make it. It's not tough if you're in the New York area. It's 35 miles west of the Lincoln Tunnel. And it'll be a lot of fun. I promise you, for at least a week after you come to this thing, you'll be hearing bagpipes in your head because that's how loud it is. So anyway, thank you very much.
That's tremendous. Thanks, Kevin. Well, this is now the third time I've been invited to that, but I'm glad we finally have a venue now. So I'm looking forward to seeing if I can get out to that one. Mario says, I'll see you in Boonton. Thanks for the invitation. So hopefully we'll get you a few more out there. We got a couple minutes before our next presentation. Let's see if we can get to a couple questions, but we have a lot of questions that have come in, but a lot of them are focusing on the BREIT redemption issue. Sure. They're concerned about what this might mean. One question that might be the most poignant asks, is the Wall Street Journal correct that the non-traded REIT NAVs, such as BREIT, are likely inaccurate at this point? And is that a concern for you?
No, I think you always got to challenge it, right? They bought a lot of product at the top of the market, no question about that. So we're going to have to watch that and monitor that very carefully. But I'm not alarmed by it. We look at it very carefully every month as they report every month. They value things every month. So we think the parties here do a good job valuing it. Is there some downside bias? Maybe a little bit, but nothing that we're worried about. We think it ultimately will hold up. And the issue really is investors are able to make decisions like they never could make before. Before, you bought real estate and you were in it for 7 years, right? You didn't have the ability to make a change or a choice. Now you can hit the eject button, right? And you can get out for up to 5% a quarter. You got to get in line, and 20% a year. That's staggering. I mean,
these aren't meant to be liquid investments in the first place.
No, not meant to be liquid, and them giving you, BREIT alone, $3.5 billion of liquidity for BREIT alone, another $700 million for SREIT. That's $4.2 billion of liquidity in this quarter. That's gigantic, and I think people need to appreciate that. And they structured it to do that. It's set to do that. We don't have any concerns about next quarter or the quarter after that. They got a runway that gets them into 2024 without liquidating another asset or raising another dime. So we think it's great, and it's unprecedented, and it's something that should be applauded, not criticized. And you always want to challenge management on value, always. You always want to challenge them on value. I think they're getting a message that maybe they are being challenged on value here. So they got to stand up. And as they sell assets, if they need to meet redemption requests, all that'll show up. All of that will show up.
Yeah.
So we think the process is very strong, and we're encouraged by it.
Great answer there. We got 30 more seconds before our next segment, but last question came in from Steve. He asked, Kevin, roughly how much of these sponsors are raising capital via retail advisors versus institutional capital? Do you know the answer to that one?
I don't, but I'd say the bulk of it is retail oriented. The bulk of it, the ticket sizes suggest that it's retail oriented. That the number of investors, the size of the tickets they're writing are primarily retail investors.
Well, Kevin, thank you so much for participating with us today. Really appreciate your time.